Hello, everyone out there. Today, I am talking with Paden, right? I got this right.
Correct. You
Paden
got it.
Squires, long A. Everyone remember Paden Squires. Welcome to the Krinzman Property Playbook. I am your host, Matthew Krinzman. For those tuning in for the first time, I am a real estate broker here in South Florida and located in Aventura, Florida, with a company called One Sotheby's International Realty. I am straightforward residential. Sometimes I do a little bit of commercial brokering. I've been doing this a long time, and the podcast came about just as an opportunity to, you know, throughout my, help people with knowledge who have interest in real estate or just be on the periphery of real estate, and talking to interesting people out there in the United States and locally here as well that are bringing some different facets to the real estate world. And today I have Paden Squires, who is I guess you're a CPA and a CFP.
Yes, sir.
So that's quite a few titles you have there, some good ones. And Paden, tell us about yourself.
Yeah.
Tell us a little bit. I always like to know about the journey, how you
Yeah.
got to what you do, So
Yeah.
when you tell us a little bit about that?
Yeah. Yeah. Absolutely. The journey. Yeah. I love the entrepreneur journey. Yeah. So, like Matthew was saying there, my name's Paden Squires. I'm a certified public accountant and also a certified financial planner. So I work in the wealth and tax space, really, kind of with entrepreneurs and people all across the country. So, I have a tax planning firm. I'm located in Columbia, Missouri, which is Central Missouri, University of Missouri hometown. Um, but yeah, we have a tax planning firm that I started over 10 years ago out of my living room.
Oh
And
yeah.
yeah, my tiny little first house, me and my wife bought together in 2014. I opened up my own tax practice. I came out of college, worked kind of the traditional route, did different banking, insurance things. I
Right.
quickly found out that like being an employee isn't for me. Like I don't fit in that box whatsoever. I'm a good employee. Like, people would say I was a good employee, but I absolutely hated it. Like I didn't like being on people's schedules or people necessarily telling me what to do. Like I'd get like 10 hours of work to do a week, and by like Monday at 2, I had nothing.
You were done. Yeah.
I was like
I
boring out
get
of my
it.
mind, right?
Do you have to wear a white shirt and a tie to work at the time?
I didn't have to wear a tie. That was a good part
Okay.
of it. I was, my last real job I had, I was in worked for a massive food manufacturing company called ConAgra. They're
Oh
huge.
yeah, yeah. There's just a
Frozen.
small companies, very small.
Yeah, yeah. So they make almost everything in the frozen food, right?
Yeah.
And I was like like a cost accountant. Like, we're using the right amount of peas in the pot pies and stuff like that, right?
How many?
Um,
Okay, now you opened up this to me. How many peas in the pot pie?
Yeah, that's a great question. I don't recall. It's been been a little over a decade, but like
Okay.
we were tracking variances. I knew how many peas were supposed to be in that pie.
Okay.
And then we had our real usage, and like, okay, that's cost accounting, right? You're tracking, what you're supposed to use versus
Sure.
actual, and trying to figure out what the problems and trying to make the manufacturing, more and more efficient, right?
Right.
So
Can't
I
have too
did.
many peas in the pot
Yeah,
pie.
you don't want to,
Then it throws it off, throws the
well,
weight off, and then there's like, oh, we had one too many peas. Now we got to raise the price.
and here's the thing: when you're doing the manufacturing, so I don't know if you guys will throw out some brands here and brand them, but like the banquet pot pies,
Oh, sure. I've heard
yeah,
of
the
it.
little
Yeah.
like 50-cent pot pies. Every single one of those comes out of the plant that I worked in Marshall, Missouri. Every
Wow.
single one of them. And
Wow.
they make like 1.2 million pot pies a day. And so
Amazing.
when you're putting like 2 extra peas in every pot pie, you can have a huge cost issue, right?
Sure.
And so that's, I get paid to track peas and
Yeah. Heck of a niche.
yeah. So and so, obviously I figured out that wasn't what I wanted to do. Wasn't a great employee. I kind of hated sitting in a cubicle all day.
Mm.
While I was there, I always been a good student. I had got my master's degree, trying to figure out what I wanted to do. Started studying for the CPA exam and didn't tell anybody. Didn't tell my boss, didn't tell anybody I worked with.
Wow.
And started studying for the exam while I kind of sat there in my cubicle and listened to CPA audio. So long story short, I passed the CPA exam in about 8 months. Kind of told my boss. After I passed 3 out of the 4, I finally told her I was doing it, and then because my plan was just to quit my job, and
Right.
that's what I did. Once I did that, opened up my own tax firm. I'd never had prep taxes for anyone ever before that. And opened up my own business and started rocking and rolling. And, it's been about 11 years since then. And growing as it was today, I got a whole team that works for me.
Yeah.
We work with clients really all across the country. We specialize in high-level tax planning. So not just, yes, we prep your taxes. We prep taxes just like anybody else with prep taxes. But our model really focuses on that proactive. We proactive. We meet with our clients on a quarterly basis throughout the year, where we're really planning, and strategizing around your tax liability.
Well, so I interesting. So quarterly, you're meeting with all your clients?
The people that are in our advisory services. Yeah,
Gotcha.
absolutely. Yeah.
Gotcha. So that's good. So you're helping them plan, obviously, not just for today and tomorrow, way down the road as well. And so we have a lot of tax issues, especially in real estate. There's the 1031s, there's deferred sales trust, there's all these different mechanisms when it comes to real estate, from and also for how you purchase real estate and how you depreciate the assets and the value and cost segregations and things like that, which I would think that most, honestly, as a real estate agent, I have I honestly, my knowledge base on that is small. It's from what I know and I've learned, or I've been taught, or I've heard, someone else has imparted that information to me. But I imagine there's a lot of investors in real estate who don't know a lot about it. They'll just buy, I'm going to buy the duplex. I'm going to buy a fourplex. I'm going to buy this warehouse. Small, like the small investors. Obviously, the bigger investors, they have the knowledge base, they have the advisors. But on the smaller scale, which is mostly what I would say I deal with, there's things that they don't know. They're going in blind a lot of times, and they rely, obviously, on the real estate agent to guide them. But there's only so much knowledge we have, and then there's the professionals like yourselves, the real estate. There's also the real estate attorneys, and there's the CPAs, accountants, property managers, all involved. So in real estate, we have a lot now. We're having some, there's some laws that are going to be changing soon, or be permanent, coming down, as far as tax code. And how, on the federal level, does it affect us as investors in real estate? What's that affecting us? What are we seeing on the horizon? The new, the big, beautiful bill that just came through, right, just came through the House, and now it's in the Senate, and the Senate will argue back and forth. What are we seeing there, especially, and how does that affect the investors? Obviously, we want to gear it to Florida, but this overall, I guess there's 1031 exchanges apply to everyone, and at least because it's federal law. But how does that affect the people here? What are we looking for?
Yeah, no, that totally great question. In the current environment right now, we got a lot of stuff up in the air. And you're right. To back up just one second there, Matthew, that in the real estate world, you guys do have a lot of different avenues and different things in the tax code that are really specifically written for real estate in the industry, right?
Yes.
Just generally speaking, the Congress and whatnot, they want to encourage real estate investment and development and whatnot. So with that being the case, there's a lot of flexibility in the tax code for people that work, that are real estate professionals or, full-time investors. You just have a lot more games that other people who aren't in real estate can't play.
Right.
So that can be very attractive. But in today's world, you're right. What is it? The OBBB. These 3 Bs, one big beautiful bill or whatever, right? So, that's currently in Congress as we're talking right now. It did pass the House by the slimmest of margins. It's got to go into the Senate, which the Senate's going to, they're basically going to write their own bill. So then the Senate's going to pass their bill, and then it's going to go back to the House. Then the House is going to have to pass it, and then ultimately, Trump would sign off on it. In the general consensus right now of the drafts that everybody is seeing is that it's going to be a lot of business as usual. By that I mean like the Trump tax cuts extended kind of like they have been in place since 2018.
Right.
The one big kicker, I think, for real estate people, and you talked earlier about cost segs and depreciation and whatnot, and we can dig into as deep as you want in that, but 100% bonus depreciation is in that bill that the House passed. Now, once again, it's got to survive the Senate version and everything, but that is, for those that don't know what that means, 100%.
Yes, please.
100% bonus depreciation means in year one, you buy an asset, you can write the whole thing off.
How so?
So it gets fully depreciated on your tax return. So, for example, and this is, we're going to get in the weeds a little bit here, but for example, when you buy residential real estate, a rental, right?
Sure.
The tax law says you have to depreciate that over 27 and a half years. So, let's say, you buy a $500,000 house, over that $500,000 gets broken up into little chunks.
For 27 and a half years.
For 27 and a half years, you're writing that off, right?
Yeah.
When you get into a thing like cost segregation is a tax strategy to come in to look at, say, that $500,000 house you just bought, right? What you do is you come in and look at that house and you break out all the components, everything that's not part of the structure of the house. So say appliances, electrical, plumbing, different things, ceiling tile, carpet, whatever, right? All these different components that aren't part of the structure. So the cool thing about those components is they can be depreciated faster. They don't have to be depreciated over 27 and a half years. So most of those things have like 5-year, 7-year, 15-year lives. So they get depreciated faster. And here's the real benefit is that those pieces can be bonus depreciated. So basically you can strip out everything except the structure of the house and write off all of it in the year you buy the property. And that's where cost segregations can get very, very strategic, especially for people that are doing real estate at a high level. Cost segs. The interesting thing also about cost segregations is you don't have to do it in the year you buy the property. So, let's say you bought the property last year and you started renting it out. And this year you're like, oh man, I'm going to make a whole lot of money from one thing or another. You can decide to cost seg that property this year and bring all that depreciation into the year you do the cost segregation.
What would be the benefit? I mean, there's obviously a tax savings benefit there, but why do it all at once, right? Rather than spread it out.
Yeah, it's time value money, right? So it's time value money. So you think about it, you're not creating additional expense with the cost segregation. You're just pulling it all forward, right?
Gotcha.
So it all forward. So and here's a rule of thumb, and this isn't exactly perfect, but a thing for the listeners to take away is that with 100% bonus depreciation and a cost seg, buying a property, and once again, everything's personal and it depends on your own tax situation, but you can get 10 to 15% of the cost of the property back in tax savings. So meaning like you can almost, in the right situation, you can almost pay for your down payment if you're talking about 20% with tax savings. So this is like, it's using leverage, it's pulling forward expense that allows you to just keep your capital and keep compounding it without having the drag of taxes taking your money away from year to year.
Could you, in effect, if you took, let's say you accelerated everything, you took this 100% bonus depreciation, now you're talking about you can possibly get back 10, whatever it is, 10 to 20% back. So it's basically it's 10% to 20% coming off your taxes. Is that it? It's not the...
Well, let me just use a real like example.
Please.
So let's say we bought that $500,000 property, right?
Okay.
We bought a $500,000, rental that we're going to make it a long-term rental, right? Single family house. Let's say we cost seg that. Rule of thumb, you say 20% of the property is going to be an expense of depreciation, additional expense.
So you're looking at 100,000.
Yeah. So $100,000 of additional expense on your tax return than you would have had if you wouldn't have done the cost segregation. So depending on what tax bracket you're in, if you're in a high tax bracket, call it 25, 30%, right? 100 grand times 30% is $30,000 in tax savings, right?
Wow. That's huge.
Yeah.
So that would come off my personal. So that'll be come off my personal at that point. Cause even, I guess you're running it through, you're running your business through a business or a PA or LLC. What are you doing?
K1. Yeah,
K1.
yeah. Typically, these are either in LLCs that are just reported directly on your tax return as what's called a disregarded entity, or they're in like a partnership or an S corp return or whatnot that would come through on a K1. But really, really long story short, all that income passes through to you personally to pay tax on. Yeah.
Yeah, I know. As a real estate agent, I'm a PA, so I run everything through my business, and I could use more expenses. That's for sure.
Well, and one thing that it talks about, so real estate professional. Let's talk about that for a second. That is a tax status with the IRS. So you can call yourself a real estate professional, but the IRS itself has a definition of what is a real estate professional. A real estate professional is someone that works at least 750 hours a calendar year in real estate, and doesn't do anything more than real estate. So meaning like you couldn't work 750 hours in real estate and then 1,000 hours at your office job. Then you wouldn't be a real estate professional. Now, if you work 750 hours in real estate and 600 hours in your office job, well, then you're a real estate professional.
It's whatever you work, whatever the hours or however.
Yeah. So minimum of 750 and no other activities that are more than real estate.
Interesting. So just one quick, just get back to the cost segregation. Is there, so if I'm a property owner, I bought this rental property, how would is there an itemization sheet that we go through? Like, hey, here's the oven, here's the refrigerator, here's the electrical panel, AC. Is there like a list that you go through and like, all right, how do you assign a value to each?
Yeah, and what I would say is yes, that's big picture kind of how that's done is assign a value. What I would tell you is probably not a good idea to like DIY cost tags. Just big picture.
Sure.
But yeah, that's what's done, right? So there's a couple ways to do it. If you do real large properties, you might actually have to have somebody come on site, like commercial type properties. What I would tell you is the vast majority of properties can be done without site visits or anything. I would say any properties generally below like $1 million. There's acceptable ways to do that by the IRS that keeps the costs down, and you don't have to do this big like engineering study and
right.
But like on smaller property stuff below $1 million, like, I mean, you can get a cost seg for a few $1,000 or something that, that costs you that. But the thing is, you may spend a couple $1,000, which will also be tax deductible. And then you get, $30,000, $40,000 worth of extra expense kind of created not out of thin air, but like extra expense that was just created.
Interesting.
So it can be, it's going to be a very, good ROI on your super.
No, that's great. So anything changing on the 1031 the exchange world, front that we should expect to come out of this the OBBB, whatever. Yeah.
I don't expect any changes coming from the 1031 exchange. That is a very popular thing, and I see that basically staying the same. Something else that the listeners may or may not know about that's kind of interesting deal in the real estate world is what's called opportunity zones.
Yes.
Opportunity zones, they came out in the first Tax Cut and Jobs Act. Yeah, came out in 2018. And it seems like in this new bill, it's going to get reworked and basically done again. So I can run high level just what that kind of looks like, because it can be a really effective capital gain mitigation strategy.
I've had people use that. It just depends on where the location of the properties are. You have maps for those things, and this is where you can this is where you can buy. But do you have a time limit still on as to how long you have to improve the property once you purchase property and opportunity zone?
So there's a couple ways you can go after opportunity zones, right? You can either try to develop your own, right? Or there's also funds out there that, like people pool and raise money, and you just drop your money in this real estate fund that is opportunity zone fund approved, right? So there's a couple ways you can do it, right? You can do your own development, or you can, just latch onto somebody else.
Yeah. Sorry, go on.
No, yeah. So the tax benefits are like you get to defer your capital gains. So let's say you sell a property and you made 200 grand on it, right? You can take that 200 grand. You don't have to take all of your money. You just have to take the capital gain. Right. So it's different.
Right. Hold on. Hey, Paden, you're just, you're getting some feedback on your microphone.
Okay. Does that sound better?
Yeah.
Yep. Yep. Okay. So on the benefit about the Opportunity Zone Fund is that you can take some cash out of the deal, right? Unlike the 1031, that if you take any cash, there is going to be some level of tax bill, right?
Yeah.
With a opportunity zone, you just have to put your capital gain into an opportunity zone. So once again, let's say you sell a property, you made $200,000 capital gain. You can take that $200,000 and put it into an opportunity zone, right? It could be your own fund, it could be, or some other fund that's doing real estate. But long story short, let's say you drop that money in there next year. This happens next year. You get to defer the taxes on that 200K. So in the current legislation of that's about to pass Congress, or will eventually, that would delay it to like 2036. So if you sold a property in 2026, put the gains into an opportunity zone, you don't have to pay a tax bill on it for 10 years. And here's the kicker. If you own that thing, so in year 10, your tax bill is due, right? Like you have a tax bill. That's when your capital gain has to show up on your return. These funds are generally designed to kick you out a tax-free distribution at that point. So you will get a cash-free distribution to pay your tax bill when it's due. And then the Opportunity Zone funds, if you have been in that fund for over 10 years, there's no capital gains on anything you made in that fund, that was sitting there churning and making money for the 10 years as well. So
interesting. So use the fund to pay your taxes, but that tax bill that's due in 10 years. And now you're getting paid tax-free on the distributions from that time going forward.
The way to think about it, those things can be designed as like, hey, you just drop your capital gain in there and you'll never have to worry about the tax bill or any more taxes off of that functionally, right?
That's nice.
That can be an interesting play for, that can be an amazing play in the right situation.
Yeah, definitely. I mean, especially if someone doesn't necessarily want to go back and buy another property.
Yeah.
If they're in a 1031, well, I'm kind of tired of being a landlord or whatever it is. I don't want to have to go buy something for more than what I sold this property for. So now let me just at least secure my capital, my equity that I got back, or the capital gain, put it into a fund, put it into an investment vehicle that will save me the taxes and the headache of being a landlord again, because I don't want to be a landlord. And so then I'm deferring my taxes for another 10 years or so. And then hopefully it's a great vehicle. That the idea is like, it'll pay for itself essentially.
Yeah.
By being in this Opportunity Zone Fund.
Yeah.
That's great. So when people are buying property, especially on the investment side, there's all these different acronyms we have: LLCs, S corps, partnerships, things like that. How would you advise someone in South Florida, who's buying property here to, protect asset, or just wealth management style, for the wealth management or tax efficiency what would you recommend as to when they purchase real estate, especially on the investment side of real estate?
Yeah. Great question. It's not as complicated a question from a tax perspective as it is from like a legal perspective, right?
Okay. Yes, liability side.
Yeah. So as this is much more of a liability question, right? And obviously not an attorney, whatnot. But like, my recommendations to almost any client is, hey, set up an LLC. It's just not that big of a deal to do that and have one and operate out of that. Personal residences, depending on, what your personal situation is like, having a trust or whatnot may or may not make sense. I have my personal house in my own trust, but like that's, that would be more of an attorney question.
Yeah.
But on the tax side, rent income is rent income. Right. So, whether this money is sitting in an LLC or let's say the rental's owned by an LLC, or if it's owned in your personal name, or if it's owned in a partnership with another person, well, like the rent income in all those situations is going to be taxed the same. It's going to flow to you personally and taxed the same. That's not really the strategy. You're not really necessarily strategizing around that piece, right? When it comes to taxes,
Right.
the one warning I would give around that kind of piece is like, it's generally not a good idea to have long-term rentals in an S corp.
Why is that?
Well, there's issues with basis issues and losing what's called step up in basis if you were to die because the real estate's in a corporation and not in your personal name. And here's the thing, from a tax standpoint, it doesn't provide you any benefit. It just kind of complicates things, and there's some potential downfalls out of it. The reason people do S corps is because the profits of S corps avoid Social Security and Medicare tax, avoid self-employment tax. Well, rental income's not subject to that anyway, so it doesn't.
Right, that's true.
So the typical reason you're using an S corp doesn't even make sense in a rental anyway. It's not even necessary.
Yeah, so the best would be LLC, I guess, at that point.
Yeah, generally, yeah. I mean, how I buy all my stuff is in LLCs, and it's, and maybe an LLC with me and my wife, or maybe some other business partner or whoever, right? But it's all owned in LLCs.
Makes sense. I mean, yeah, I get that question a lot, and I'd always say, look, yeah, I think you should have an LLC, but then again, I'd get the advice from someone, an attorney, or even from a tax professional.
Yeah.
Just 100%. To get that, cleared, because, last thing you want to do is give out bad advice. But I think, being around the business long enough and having enough people, good people I've learned from, and obviously, like, I'm going to use a very antiquated term here, in my Rolodex. I always ask that question, and LLC always seems to be the preferred way to hold real estate if you're doing it as an investment. On your personal, that's up to you to decide how you want to do it. I mean, keep it however. But you mentioned that there was something you said there before, step up.
Yeah.
Explain what the step up is, because it comes up. I've heard it a lot, but I think for a lot of people out there who may just not like, what's the step up?
Yeah, step up in basis, which is a very big deal in real estate for sure. Step up in basis. So let's go back to our example of we bought a $500,000 house. Okay, bought a $500,000 house, and we're depreciating that over years, right? So we bought it. Let's say we've been renting it out for 10 years, right? Everything's going well. That's great. Over those years, each year we've taken depreciation on that property, right? Because we're taking a little bit of depreciation each year. So let's say we bought a $500,000 property. 10 years later, we've written off $100K of depreciation. And once again, I'm just using numbers.
Okay.
So we bought it for $500K, but on our books, we've written it down to $400K, right? Because we've taken $100K worth of expense. If we were to go sell that property, let's say that property's worth $600K in the real world, right? If we were to go sell that property for $600K, on our books, we have it at $400K.
Right.
So we don't have $100,000 worth of income. We actually have $200,000 worth of income if we were to sell that property. Because not only is there a $100,000 capital gain from $500K, the original price, to $600K, there's also what's called depreciation recapture from $400K to $500K. And that is rental income. So it like offset rental income. So it comes back as rental income. It's not a capital gain. You got $100K of a capital gain and $100K of like rental income there if you were to sell that. Right?
Yeah.
And I've kind of lost my train of thought of what's going on.
No, so you have your depreciation.
Step up in basis.
Yeah.
Correct. Yes. So in that situation, so say this is Matthew's house. It's worth $600K. He bought it, written down to $400K, right? Right. If you were to sell that right now, Matthew, you would get that $200K of income, right? $100K of depreciation recapture and $100K capital gain. Here's the awesome thing. Let's say Matthew dies.
Oh no.
Oh no.
He's very sad for me.
So he dies, right?
Yeah.
For some odd reason, he puts me as the beneficiary on that house.
That's very nice of me.
Good recommendation here.
Yeah. My wife will be very upset, but that's okay. She'll get over it.
Well, all right. We'll give it to your wife. So your wife gets it. She gets what's called a step up in basis. So remember, if you would have sold it the day before you died, Matthew, you would have got $200,000 with income.
Right.
when she inherits it, say your kid inherits it or whoever, inherits it, they get a step up in basis. Their basis in the property becomes the fair market value on the date of Matthew's death.
Okay.
So if you would have sold it for $600K, you would have got $200K worth of income. You say your daughter inherits it tomorrow or whoever, she could sell it for $600K and gets no income because her basis in the property, what she
It's now 600
is the fair market value, which
right?
Is $600K. So that is, it's a really interesting. I work with a lot of different people in the wealth space and whatnot, and you get to clients that are getting, say in their 80s or whatnot, and we have all these assets with these
Right.
capital gains and whatnot in it, and a lot of them, it's like we can't sell them because we don't, like it was literally the strategy is to just never sell them until the kids inherit them, and then they can sell them. Because
it's a nice inheritance,
Yeah,
it's
yeah.
nothing wrong with that. I mean, if you've been living off the income or even at least deriving from these investments all these years, okay, so you've done okay, you've done well with it.
Mm-hmm.
Now, unfortunately, you've passed away and you've made your line of succession. At least you've planned for that. Whoever's going to inherit or the trust or however you set it up, that your beneficiaries will now have that benefit of those properties, and they may not want to continue being landlords or continuing. They sell it. They made money. They got the money.
They can get
at
out
that
of
point.
it tax free, right?
Right.
Like so, they can, you have, say a real estate guy like you spent his whole career building this big portfolio, and like it would be a nightmare if you sold it, but like your kids or whoever, they can strategically exit that and get out of there without really any tax.
Right. Is there? I mean, but just so we're clear, because I've had some people, I've had a couple of estate attorneys and probate attorneys, and we've talked about, estate taxes. I know it's a threshold. So if they're under that, was it how much is it? 30 million, I think, is the threshold now.
Yeah, it's roughly, and this is part of what's going on in the tax bill currently.
Right.
But it's roughly 15 million.
15. Right.
Right.
Per person.
A husband and wife would be 30 million.
Right. So
and
if you're under that, you're okay.
Yeah. So, and just to be clear there's a couple different things we're talking about there. We're talking about estate taxes, right? So if you have a large estate, like you were talking there over 30-ish million or whatnot, the estate could be subject to income taxes. And I can't remember off the top of my head if Florida has this or not, but most states have no inheritance tax. Like the person inheriting the money has no tax to pay.
Right.
The estate may because it's so big or whatever, but ultimately the person receiving the assets, they don't have any liability.
No, you're right. But as long as they're under that basis, whatever that number is, they're okay.
Yeah.
I read on your website, you had something about that every investor needs a tax plan. Real estate investor needs a tax plan. So, and not just someone to, here's all my forms, here's my spreadsheet, here's all my expenses. Do what you want with it. This, send me the form back.
Yeah, just let me know what I owe.
Yeah, whatever my K1 is, and then I do my personal, and okay, great. But planning, it's essential. It is essential for. Not just for someone who's in the real estate investor, but I think anyone who's working for an entrepreneur, working for yourselves, like myself, like you. There are all the real estate agents out there, all the mortgage brokers out there who have their own shingle and they're working for themselves, or attorneys. Yeah, we need a plan. We need to know what to do. And I'm probably one of those. And if my accountant listens to this one, she's probably going to be like, yeah, no, he's terrible at keeping everything straight. He is. Yeah. She yells at me every year. Yep. But that's my own. I think that's my own poor planning. But I want to at least let's impart some good, reasonable, actionable advice for people to plan their taxes and how to plan for it every year or quarterly. Like you said, you meet with some of your people on a quarterly basis to help and structure what plan. Yes. Why do we need a plan?
Yep. Let me, I think it might be best if I give a story and then
okay. I love the story.
Talk a little bit about that. So, right. Yes. We are very huge proponents of proactively planning around all this stuff, right? Because, you know, if I talk to you on April 10th or whatnot, like there's not much I can do for your situation.
No, I'm a late
You know what I
filer.
mean? Like,
By the
it's
way,
like,
I'm a late.
yeah.
Oh, in
Well,
case
by that I
IRS
mean,
is,
maybe
I'm
it's
a late
October
filer.
10th, right?
Yeah, I'm a late filer because I am just terrible. I'm a
Well,
procrastinator to the nth degree when it comes to this because it's like, ugh.
yeah. Well, mine's not done either, and we're in late
Oh, okay,
May.
so I'm okay.
Well,
I
I'm
feel so
waiting on a
bad.
K1 that I have no control over.
I gotcha. Okay. Okay, so
But
it's my
and
own doing.
it's a real estate K1.
Oh, well, even better.
But so a story, a quick story. I have a veterinarian office in the state of Texas that we kind of brought on as advisory client. Great business. They do well. They make good money, right?
Yeah.
They also own the real estate. They also own the commercial building, right?
Okay.
That their business owns. So you got a commercial building. It's kind of in its own LLC, and you got the business that's in its own like S corp. And then the business is renting the building, right? Very very common structure. Here's the thing. And the partners that were doing this before had worked with an accountant and actually did a cost segregation on the property and whatnot. So there was some level of thought, I guess, going on there. We came in there and saw the cost segregation. The problem with the cost segregation, it created this massive expense, but because of the way the everything was structured, like they basically had this big loss that would take them 20 years to use up or whatever, right? Like,
wow.
So they couldn't use this loss right away. But what we came in there, investigated their lease agreement and how they were paying rent from one entity to the other. And we went and pulled some comps and we changed it to a triple net lease and jacked the rent way up that we could justify, all based off comps and stuff. We didn't just make up numbers, but we justify everything we can do in case we were audited. Like, it's all documented, but we were basically able to eliminate an extra 60 grand of income from his tax return this year and every year for the next like 5 years.
How much?
60K of income was basically taken off his tax return. So times 20, 30%, we're saving this guy 15, 18 grand a year, every year for the next 5 years. So it's things like that. That there is almost no one taking a strategic eye to anything going on your tax return if you're just working with a tax preparer. And that is saying nothing necessarily. I know, Matthew, you were like, oh, I'm a procrastinator and whatnot. Well, that's true. And a lot of us are, don't get me wrong, but like, it's really an industry problem too. It's not just the entrepreneurs. I mean, earlier you described the typical experience of here's all my stuff, work it all up and just let me know what I owe. Well, yes, your taxes need to be done, and that's somewhat valuable. But like, what's really valuable is me having that conversation with that vet about that lease agreement.
No, that was fantastic.
Not filling out tax forms, right?
Right.
So and what I'm saying when it's an industry problem is here's 95% of CPA firms. They're mom and pop firms that have, call it a handful of CPAs in there. They're all generalists. They do taxes for literally anybody and everybody. You got your mom and pop, and then you got your, your little small businesses all over the place. And they are way overloaded with work. They're just doing compliance work and they get paid to just pump the tax returns out. So like the strategy is there's nothing motivating anybody to be strategic on your tax return.
Understood. So you saw the issue, you saw the problem with your client, and you came up with a solution. That's really what it is. So that's part of being strategic in the planning. Hey, you guys have this issue. I think we have a solution for it. We can solve this. So we talked. So this veterinarian, not only they owned the property, they were the tenant as well. So sometimes, I get, this is a good question. I get a lot, and again, commercial, I do some commercial. It's not, it's not my main focus of business, but, especially when I have someone who owns a business who's thinking about either leasing or owning the property. Pluses and minuses to that from a tax purposes. Rather like, hey, I got my widget store, I'm going to open up a store. Should I lease it or should I buy it? What is the benefit of either? Is there, how do we determine that as you as a tax professional would say, the CPA would go to my client, say, hey, you know what, talk to Paden, see what he has to say. How would you, what advice would you give, on that?
Yeah. Great question, Matthew. My advice would be, first and foremost, is like, does it make sense from an investment standpoint, right? Like, would you buy it if it was, like, even if like it's just a standalone store or whatever,
Sure.
would you buy it, right? And maybe it has nothing to do with your business. So that
Right.
would be like the first filter I would look at it through. The next filter would be like, okay, since it is my own building and I kind of have control over it and the rent and whatnot, if I ultimately were buy it, is there efficiencies I'm getting out of by doing that? Because, like, everything being equal, like, yeah, I think it's better off owning it, right? Just because you have
asset.
You have an asset, you're paying down debt, you also have kind of control of it, so you can maybe play some games or whatever. But then, it's really, I would purely evaluate it as an investment, and okay, it can maybe be a little worse investment than maybe a standalone one, because it actually gives me a few other benefits and games I can play in my own personal tax situation, if that makes sense.
Sure. In Florida, I mean, if you have a client down here in the state of Florida, South Florida in particular.
I have some.
You do? Oh yeah. All right, good. That's
Sarasota
good to know.
Area.
Sarasota, it's that way.
Yeah.
It's a little bit, only a few hours drive on the other side of the state, but yes.
Hey, it's the same state.
Nah, you'd be surprised. We're very
maybe I'm speaking out of turn.
Yeah, Florida is very different from yes. South Florida is very in central and the West Coast, and Central Florida.
I'll be flying through Miami's airport next week. So,
oh, God bless you. I pray for your soul. No offense, people, but that's a rough airport. That is, I mean, unless are you flying in to go somewhere else?
Yeah, I'm just stopping in there. I'll be there a couple hours maybe, but I will have the entire crew and the whole family with me.
So. Oh, very nice. You're going on a nice vacation then.
Yeah, we're heading to the Dominican. Yeah.
Okay, well, that's nice. I heard of great things about the Dominican Republic. It's I've obviously have friends, people that I know, but I've just seen Dominican Republic. It seems to be booming right now, and it looks like a great place. I should go visit. It's not that far for me.
Yeah.
What can we do as a real estate investor here in Florida to reduce the liabilities, the tax liabilities, going forward? What can we be doing? And also, as they grow the portfolio.
Yeah, and and I'll kind of give the general advice I give to a lot of my clients, and I've worked with over 1,000 entrepreneurs over my career, and a lot of people, obviously are talk about real estate a lot, right, or interested in real estate. And my advice given to people just kind of starting out in real estate, if you're just starting out, is like, realize it's a long-term game. It's not I mean, just like everything, there is no such thing as like a get rich quick thing. Like,
oh man, I wish
you did get rich quick, you're probably going to lose it.
Yeah, that's you usually lose it. That's very true.
Right, because you didn't know how to get it, right?
Right. Like, it's a scam or something usually. I remember I'm just going to go off topic for a second, but I'm sure you remember these guys like late at night doing the infomercials, and it was like, "Hey, you want to be like me in real estate? Buy my book." And
no money down.
Was it Carlton Sheets was one of those guys, and then it was
there was a lot of them.
I remember there was this one guy always on a yacht with girls in bikinis. You want to be like me? You gotta buy my. I'm like,
they all ended up. A lot of those same people on social media now.
Yeah, but they all end up in jail.
Yeah.
That's the funny thing. They've all ended up in jail at some point because they're scammers. But I went off topic, about the get rich, but because you mentioned it and just jogged that, that core memory of me being up late at night and seeing these. I'm like, it doesn't work. You can't. Yeah. But okay. Sorry. I digress.
And once again, understand that, right? Like it's a long-term game, right? Like you're going to buy your first property and maybe it cash flows $100 a month or something or whatever. And you're like, yes, right.
You're ahead. You've done ahead, but you hope you gain appreciation on the property. You bought I don't know. There's never a right time. There's always a time. There's a time to buy. And there's time to sell. Right, good, bad, indifferent. But owning a property and you say you get $100. Okay, great. You cleared $100. Now you have appreciation. You want to grow that portfolio. So how do we grow it while hopefully reducing our tax liabilities?
Yeah. So, it's once with everything, and it's starting with a plan, right? A lot of people, kind of make the plan, or you hear people make a plan like, I want to acquire one property a year or whatnot, right? And maybe you want to do faster than that, maybe you want to do slower than that, and that's fine, and it just kind of depends on your capability and how committed you are. But it's understanding that if a property is like self-contained and paying for itself, and you don't have to feed it,
Yeah.
you're probably in at least okay shape there. The problem is people run out and get in over their heads, buy something, and realize you just bought a bunch of liabilities, stuff that you have to feed with cash every month, and that's when people get themselves
True
in
that.
trouble.
Very
right?
true. Yeah.
From a tax standpoint, as you begin to build your portfolio and the more and more properties you acquire, and then you start trading properties and different things, the tax games get even cooler and sweeter, right? Like there's levels to this stuff, right?
Right.
There's always levels to this stuff. What I would recommend is also just always being a consistent learner, right? Learning about this stuff, listening to podcasts like this, learning about, you don't need to be an expert in the tax world, but it's like, hey,
Right.
if you're going to really dive into real estate, like being familiar with a lot of this stuff is super helpful. So it's doing things like that and just consistently learning, and make sure you're not being overconfident. I love confidence, but most of the time people's confidence is there because they're ignorant. And, it's like false confidence, right? You get really confident before you realize, wow, I don't know near as much as I do. Thought I
Well,
did.
yeah, it's the how many beers do I need to be confident? It's
Yeah.
like, the more I drink, the more confident I get, or the better looking I
Yeah.
get. One of the two.
Right.
Um,
So
so
it's once again being around, it's finding professionals in your life that can
that's
speak
what I was gonna.
wisdom.
Okay,
Yeah.
great.
That can
That I
speak
was
wisdom to you, that have been
100%.
there before. Take advice from people that have done or are doing what you want to do, and not from people that aren't.
Oh, that's a great line. It's so true. And I say to people like, oh, and I've been in real estate. I've been around it my whole life. As far as the sales side, I've been in it a very long time at this point. I don't even want to say the years anymore. But I always say if the day I stop learning something new in this business, or I see something I haven't seen before in the business, I'm done. That's it. I'm cool. I'm gonna walk out of my desk. I'm gonna leave my computer behind. I'm gonna leave my phone behind. I'm just gonna go home and say to my wife, "That's it. We're done." What she mean? I learned and I seen everything in this business that it could provide for me. So yeah, luckily I'm not there yet. I hope I probably will never get there. We'll never get there. It's
Well, yeah, and
impossible.
it like if I hear anybody said that around me, I would turn the other direction and run. I'm like, you're dangerous. Like, if somebody's like,
I know
there's
everything.
nothing else
No,
for me to
no,
learn,
no. You don't know everything. That was always a
that's
common
like peak
argument.
dangerous.
Look, that was always a common argument with my father and I when I got into an argument with him, or we both arguing. And always, oh, you think you know everything? And I'm like, yeah, I do know everything, because that's something. I'm being a smart ass.
Yeah,
I'm being
sure.
a wise ass to my father.
Yeah.
What else am I going to do? Yes, I know everything. Of course I do. I don't. But I still got a lot to learn in this business. It was one thing I just wanted to quickly
Yeah.
in I'm sure you see the same in Missouri or around the country, and I know in Florida, especially, we have a lot of these investors who come in, flip properties. There's got to be a huge tax liability for them when they're buying and flipping on such a short basis. They're in and out, within maybe less than a year at times. And there's got to
Yeah.
be, how do they minimize that? Because I'm sure there's going to be
Yeah.
people listening to that, and I have people like that. How do they minimize their tax liability?
Yeah. So if you're a flipper, right?
Mm-hmm.
You heard me say earlier about not putting properties in S corps,
Right.
right? This is the exception to that.
Really?
Yes, because flipping houses is, it's like a remodel business. It is a
Yeah.
remodel business, right? It's actually active income, and I know people misreport this all the time on their tax returns, but because they want it to be a capital gain, even though it's not. So if you're in the business of flipping houses, it's just like any other business. Your income is subject to self-employment tax unless it's in an S corp model or whatnot. So. You're right. It is less tax efficient. But then at the same time, if they're doing that at a large scale and doing multiple properties, they always have money to spend. And really in the tax game, you know, and I would guess in a thing like that, if they're very profitable, is like get the money back out the door before the end of the year.
Is that it?
That is
So
like, yeah, I mean,
before,
there's a lot of that really, where it's
yeah.
like in December and everybody's like, get rid of the money. Right.
So they make, if they've done business throughout the whole year and they got this excess capital.
I mean, that's one strategy. Yeah.
Is
I mean, it's definitely,
make sure you
you're
buy
looking for something to buy. Yeah.
That's
absolutely.
it. Be sure you buy something before you close on something before the end of the year.
Right.
At that
I mean,
point.
you know, in the most basic tax planning strategy of the world there is delay income, stop sending invoices in December, and prepay every expense you can. Right. Like anything you can write a check for in December, write a check for it. Right.
Yeah, no, you're right.
Just trying to get all the money out the door. Right.
Right.
That's.
I got you.
Whoever has the money at the end of the year has to pay tax. It's like a hot potato.
Yeah, that makes sense. It's like cash on it, cash on hand, and it close of business day at the end of the year. That does come into effect. Yeah, you're right.
You better get those checks postmarked out the door.
That's interesting. That's actually really good advice. But yeah, I just was always wondering, how as a flipper to best, not that I'm a flipper, but I have obviously know people, how would they,
yeah, depending on their own situation, it very well, could be an S corp.
Interesting. Okay, that's good to know. All right, Paden, quick, tie up. Just give us a quick tie up on this, and then how can we find you? Who should be calling Paden? And saying, hey, I need your help and all that. So
100%.
let's tie that up.
That's great. Yeah. So guys, obviously this is is what I do professionally and every day, and me and my team work very passionate about this stuff of saving people money and taxes so they can grow their own net worth and their own families and communities and whatnot. But yeah, I mean, I specialize in working with clients all over the country, so there's no limit. And I tell you, the vast majority of my clients anymore are not in the state of Missouri. So,
that's good to know.
Geography is not an issue necessarily.
I guess with the advent of, obviously, the advent of the internet,
I mean, the vast majority of my meetings are just like this, right?
Right.
Trying to connect with people and whatnot. But so my firm, Squires Tax Planning. You can find us at squirestaxplanning.com. There's a couple things on the website that you can pull off there. We kind of have a free assessment that allows you to kind of see, answer a few questions to see how likely it is that we might be able to save you some money on taxes. And then there's also kind of like a tax saving checklist on there, just kind of a free gift to give you something to check out of the website as well. But the best way to get a hold of us is reach out to there. You can schedule a call with me if you're interested in, planning services. The other things, I'm really passionate about is entrepreneurship. You can also find me at my own personal website, PadenSquires.com. There I got my podcast, Behind Your Success.
And how many episodes or
podcasts
you have?
So there's, 75 or so released. We've recorded close to 90, I think.
That's amazing.
At this point. So I love that, you're into entrepreneurship content. It's really the whole point of the show is just to interview entrepreneurs and get their stories and, figure out why they're successful and what lessons we can learn from them. So
awesome.
You want to talk to me about the tax side? I'd love to talk to you that squirestaxplanning.com. And then personally, I have a lot of entrepreneurship content out there just under my own name.
Yeah, you have I mean, you're on everything. It's like,
and that's my social media people make it a lot easier for me to do that. I'm all about delegating and staying in my own lane as best.
Smart.
As possible.
I like that.
Delegating. My lane is talking to people.
I like that. Delegate. Yeah, you have Instagram, Facebook, LinkedIn. Your podcasts are available on YouTube, Apple podcasts, and also Spotify. And you even have a TikTok. Do you do the TikTok dances?
Yeah, so I've it's amazing. I'm one of probably very few CPAs on TikTok. I've actually never been on TikTok. My social media,
okay.
My videos are on TikTok.
Hey, whatever. There's a form of you on there.
Yeah, I refuse to download any more social media apps on my phone.
Same.
Just because it's like I don't want to get sucked into a whole nother world. I already spend too much time.
Right. So it's Behind Their Success podcast and Squires Tax Planning. Is that it?
Yep. That's
okay.
It. And what I would tell you, if you actually want to interact with me, Facebook's probably the best place to go. Like if on social media, and that's where I'm actually interacting and whatnot.
Got it. Okay, great. Well, I appreciate the time, Paden. and, coming out here and talking with me today and talking with, hopefully people will be listening to this, watching this. We'll get some good insight on, tax planning and tax planning for real estate, especially. This is very helpful for me. I enjoy this, like it's a little bit now. I have a little bit extra knowledge that
go.
I can
So
always
you can't quit your job today, right?
No, I wasn't planning. I couldn't. I'm under contract on a couple of things, so I can't. I have to get. At least let me close those.
I get my last closing check.
Yeah, let me at least get paid. Then maybe we can talk about that. But anyway, I appreciate the time. Thank you for coming out. Enjoy when you go out to Dominican, and and hopefully Miami International Airport won't be too daunting.
Yeah, I'll just
of a task.
One of these days I'll just be sitting in the American Airlines lounge there waiting to leave.
There you go. I think that's your best bet there. Yeah. Yeah. Just sit there, just relax, have a cocktail and enjoy
the bar. It's good.
Yeah, that's true. That's very true. They do. All right. Hey, Paden, thank you for coming on. I will talk soon. Hopefully let's stay in touch.
Absolutely.
I'll shoot you an email later, maybe to see how I can, how we can connect and send you.
Absolutely, man.
And we'll go from there. All right.
Awesome, man. It's great to meet you, man.
Same here. I really appreciate it. Thank you. We'll stop.